Okay, let's unpack this. We've got a really interesting source today. It's an analysis of a CLSA report called When Reality Bites.
That's right. And it digs into a pretty serious topic, the stability of the whole global financial system
Hmm.
and what CLSA thinks might be coming.
Yeah, and reading through the analysis, their view is, well, it's strongly cautionary, deeply bearish, you could say, especially about the U.S. situation right now.
hmm They use some really striking language, too. Phrases like doom loop, structurally terminal, and debt-driven compounding fragility.
So definitely not holding back. It paints this picture of a financial order that's, well, fracturing.
It does.
So our goal here is to pull out the key insights from this analysis, really understand the arguments, the evidence they present, and crucially figure out what it could mean for you.
Okay, let's start with that overall bearish feeling. It's quite urgent in tone. The first big takeaway they pull from the report summary is this idea of a fundamental loss of trust
Trust in what specifically?
in U.S. Treasuries.
Mm.
The asset that's always been seen as the bedrock, the ultimate risk-free asset for the global system. The report argues that's changing.
Wow, okay. That's a big statement. For decades, U.S. debt has been the foundation. What evidence does the analysis point to? How do they show this loss of trust?
Well, they bring in some data that's quite compelling, specifically on credit default swaps, CDS.
Right, CDS. Explain that simply for us.
Sure. Think of a CDS spread as basically the market price for insuring against a country not paying back its debt. It's how the market quantifies the risk on government bonds.
Got it. So like an insurance premium. And what's the surprising finding there? The analysis mentions charts on pages 1 and 2.
Yeah, this is where it gets really interesting. U.S. sovereign CDS spreads.
Mhm.
They're trading at levels similar to countries with much lower credit ratings.
Like who?
Well, the report specifically calls out Italy and Greece, typically rated BBB plus sign. Compare that to the U.S., which is usually AAA or AA plus sign.
So the market is pricing U.S. risk similarly to countries rated significantly lower, despite the top-tier rating.
Exactly. It's a stark contrast. The analysis suggests this isn't just noise. It's institutional players, the big money, actively hedging. They're pricing in a real non-zero chance of, well, of default or something going seriously wrong with U.S. debt.
Something they wouldn't have done historically, or at least not at these levels.
Precisely. And the timeline matters, too. Looking at the U.S. CDS 5-year chart on page 3 of the analysis, this isn't some slow burn over many years.
Ah, okay. What does that show?
It shows a really sharp recent increase. The analysis notes the 5-year U.S. CDS price jumped from around 32 basis points in late 2024 to over 56 by mid-2025. It happened quite quickly.
A significant jump in a short period.
And the report's quote on this is pretty direct. They say this signals that something not very good is being signaled. The market's perception of risk changed fast.
Okay, so that's the symptom then. The market flashing warning signs through these CDS spreads, reflecting this eroding trust. But what does the analysis say is the underlying cause? What's driving this fragility?
The report identifies what it calls a debt doom loop, sometimes also called the interest trap. It's presented as this self-reinforcing negative cycle.
A doom loop. Sounds ominous. How does that work according to their analysis? What are the mechanics?
It's a kind of vicious spiral. So you have high interest rates. That obviously means higher interest payments on all the existing government debt.
Mater.
But then these higher payments force governments to borrow even more money just to cover the interest costs and, fund ongoing spending.
So borrowing more just to pay the bills on the old borrowing.
Right. And that increased borrowing floods the market with more government debt,
Mm.
more supply, which in turn tends to push interest rates.
Even higher. Ah, I see the loop.
Exactly. More debt leads to higher rates, which forces more borrowing, which leads back to higher rates. And that's what they mean by debt-driven compounding fragility.
The problem feeds itself. Does the analysis quantify this? Give us a sense of the scale.
It does. There's a table on page 10 with some simplistic interest calculations, but it really highlights the point. They call the math frightening.
Okay, lay it on us.
So back around May 2020, they estimate global debt was roughly $260 trillion. And let's say the average interest rate was just 1%.
Okay.
The annual interest cost back then, about $2.6 trillion. Manageable, perhaps.
But things have changed since 2020. Rates are up.
Dramatically. By May 2025, the estimate is debt's up to around $324 trillion, but the average rate has climbed to maybe 3.5%.
And the interest cost.
That balloons to $11.3 trillion per year.
Wow. From 2.6 to 11.3 trillion. That's huge.
It really illustrates their point starkly. In their view, this level of debt, especially with higher rates, isn't something that can realistically be repaid. It can only be rolled over, kicked down the road, while the interest burden just keeps compounding upwards.
Okay, so if the math looks that daunting, you'd think the natural response would be major fiscal changes, right? Like serious spending cuts or debt reduction plans.
You'd think so. But the report analysis is pretty pessimistic about that actually happening.
Yeah.
It talks a lot about fiscal dominance and political inaction.
Fiscal dominance, meaning the government's spending and borrowing needs essentially dictate monetary policy.
That's part of it, yeah. But also just the sheer inertia. They use a chart on page 5 showing U.S. government spending as a percentage of GDP,
And what does that show?
a clear long-term structural uptrend. It was around 17% back in the 1950s. Now it's closer to 27% in the 2020s.
So government spending has consistently grown as a share of the economy over decades.
And the analysis argues these large fiscal deficits have become embedded. They seem almost unstoppable, regardless of which political party is in charge.
They point to the debt increasing under pretty much every recent president, right? They use the term political profligacy.
Yes, exactly. It suggests this isn't really a partisan issue in practice. The spending and borrowing trends persist.
So the report's conclusion on this front is?
Quite blunt. A fiscal solution, meaning, significant, sustained spending cuts or real debt reduction. They see that as highly unlikely, just not politically feasible in the current environment.
Okay. So if you can't really pay the debt back and you're unlikely to fix it through fiscal discipline, where does that leave you? This seems to lead directly to their second key takeaway.
It does. If fiscal solutions are off the table, the report argues the only path left to manage this enormous debt burden is monetary debasement, what they bluntly call the next big print.
Printing money, essentially, inflating away the real value of the debt.
That's the core argument. The system, as they see it, cannot function without monetary debasement. It becomes the default option, the only tool left that governments are willing or able to use on the scale required.
And they connect this to other analyses too, right? I think it mentioned Paul Tudor Jones.
Yeah, they reference his 2020 analysis where he anticipated a coming inflation eruption, driven precisely by this kind of necessary money printing to handle massive government deficits and debt.
So the CLSA analysis sees this as basically inevitable now. Currency debasement is coming.
That's the strong conclusion presented in the analysis, yes.
Okay. If that's the diagnosis, unavoidable debasement, what's the prescription? What does the analysis say investors should do? This must lead to their main investment thesis.
Absolutely. It leads directly to their third key takeaway, the need for investors to shift towards what they call neutral collateral.
Neutral collateral. Define that in this context.
It means assets that are scarce, that governments can't just create more of out of thin air, assets whose value isn't directly tied to or easily diluted by government printing presses.
Things they can't easily devalue. Makes sense. So what are their specific recommendations, their key calls?
Well, flowing straight from that logic, first, government bonds.
Let me guess. Not good.
A strong underweight avoid. The analysis quotes the report calling them a hard no.
Why? Because their value gets destroyed by the very inflation needed to manage the debt.
Precisely. If the strategy is to inflate away the debt, holding fixed income assets denominated in that currency means your purchasing power gets eroded. It ties back to that initial loss of trust. Why hold something whose value is likely to be deliberately diminished?
Okay, so bonds are out. What's in?
Precious metals. Gold and silver get a strong overweight.
The classic inflation hedges.
Yeah.
Because you can't print gold?
Exactly. Seen as essential stores of value in this kind of environment. Scarce, tangible.
And what about digital assets? Does Bitcoin fit in here?
It does. Cryptocurrency, specifically Bitcoin, also receives a strong overweight rating in the analysis.
Why Bitcoin? Same reason as gold.
Pretty much. It's frequently mentioned alongside gold as another form of this neutral collateral. An asset with provable scarcity, outside direct government control, potentially offering, as they put it, escape velocity from currency debasement.
Interesting. Okay, so underweight bonds, overweight metals, and Bitcoin. What about stocks, equities?
Equities are viewed more favorably than cash or bonds long-term. They get a selective overweight.
Selective, meaning not all stocks are equal here.
Right. They highlight a specific opportunity within equities, looking towards Asia-Pacific stocks, particularly those with growing dividends.
Why Asia-Pacific? And why dividends?
Well, the analysis notes that in many Asian countries right now, you can find solid companies where the dividend yield is actually higher than the yield on their own government bonds.
Ah, so suggesting better relative value compared to holding the government debt.
Exactly. It implies you're potentially getting paid more to own a piece of a productive company than to lend to the government, which flips the traditional relationship on its head. A potential indicator of value, especially if you expect bond values to be eroded.
Does the analysis mention any specific examples? Companies that fit these themes?
It does give a couple. For that neutral collateral theme, through gold, they mention Northern Star Resources, that's NSTAU, an Australian gold miner.
What do they like about it?
They point to what they see as a cheap valuation, potential for margin expansion, and the fact it apparently doubled its return on equity. Fits the own producers of scarce assets idea.
Okay. And for the Asia dividend growth angle?
They highlight Zijin Mining, that's 601899 in Shanghai or 02899 in Hong Kong.
What's the story there?
The analysis cited strong Q1 2025 earnings, beating expectations with over 60% year-over-year growth. And importantly, an increased contribution from gold mining was seen as driving a potential re-rating for the stock. So it kind of hits both the Asia focus and the precious metals theme.
Got it. Okay, so the analysis lays out this whole narrative. Eroding trust, the debt doom loop, likely debasement, and therefore a shift to neutral assets like gold, Bitcoin, and selective equities, especially in Asia. Does it provide any data to show if this strategy is already working? Is there evidence this shift is underway?
Yes, there's a final chart included in the analysis on page 16 that they present as pretty powerful evidence. It's a performance comparison chart.
Comparing what?
It compares Bitcoin, gold, the S&P 500 index, and bonds represented by an aggregate bond index over a specific period, from late 2020 to mid-2025.
Okay, and what does it show? What's the story there?
Well, the contrast is pretty dramatic. Bitcoin is shown with a return of, wait for it, 659.88% over that period.
Wow, 660%. Okay, what about the others?
Gold and the S&P 500 both showed positive returns, quite respectable ones. But bonds, the aggregate bond index, actually showed a negative return over that time frame.
Negative returns for bonds, while Bitcoin and gold soared and stocks did okay. How does the analysis interpret this?
They present this chart as direct evidence supporting their core thesis. Remember Paul Tudor Jones asking which horse is winning?
Right.
This chart is basically CLSA's answer via this analysis. The assets with inherent scarcity, the ones that can't easily be printed, Bitcoin and gold dramatically outperformed. Meanwhile, the primary fiat-based instrument, bonds, actually lost value in nominal terms, let alone real terms.
So it strongly backs up their call to own scarce assets and avoid traditional fixed income in this environment.
That's certainly how the analysis frames it. They see market trends already validating the core arguments laid out in the report.
Okay, given this is overall a very bearish outlook, the analysis must talk about risks, right? What could actually trigger a full-blown crisis, according to this perspective?
The main trigger they identify is a catastrophic loss of confidence. Just a sudden moment where faith in the system, particularly in the value or safety of government debt, really evaporates.
How might that manifest? Any specific warnings mentioned?
Yeah, they reference warnings like Jamie Dimon talking about a potential crack appearing suddenly in the bond market.
A crack, meaning liquidity vanishes.
Potentially, yes. Or a liquidity death spiral, where markets become unwilling to roll over government debt smoothly. That could force the Federal Reserve into huge emergency liquidity injections, what the analysis calls a triage operation, basically trying to patch up the system reactively.
Sounds messy. Any other major risks highlighted?
There's also the scenario of a recession. The analysis points out that a significant economic downturn could cause the U.S. deficit to surge massively, potentially, by $4 trillion or more.
Which they label a disaster.
Right, because it raises the critical question. In that kind of environment, who would actually step up to finance such an enormous amount of new borrowing? Especially if confidence is already shaky.
So those are big risks to the system itself. What about risks to the report's bearish thesis? Could they be wrong? What would need to happen for this doom loop scenario not to play out?
The main thing, which the analysis acknowledges, would be a sudden, credible return to genuine fiscal discipline.
Meaning governments actually get serious about cutting spending, balancing budgets, reducing debt burdens structurally?
Exactly. If that happened, it would challenge the core assumption that debasement is inevitable. However,
They don't think it's likely.
no. The analysis quickly follows up by stating that scenario is considered highly unlikely, given the political realities and historical trends they pointed to earlier.
Okay, so assuming they're right and fiscal discipline isn't coming, what's the outlook presented in the analysis for, say, the next 6 to 12 months?
Continued financial fragility, more volatility. The sense is that the system is kind of lurching towards a breaking point?
But no specific timeline on when that point might be reached?
No, the timing is uncertain, but the direction of travel, in their view, is pretty clear, ongoing and likely accelerating monetary debasement as the primary tool being used.
Are there specific events or catalysts mentioned that could speed things up, either towards a crisis or towards confirming their debasement thesis?
Yes. On the negative side, things like a sharp global economic slowdown, another unexpected spike in interest rates, or some kind of major geopolitical or political event that really shakes confidence, those could accelerate the doom loop.
And catalysts that would actually support or confirm their debasement prediction.
Things like another very large government spending package getting approved, or more overt actions by the Fed to manage bond yields or inject liquidity, what some might label stealth QE or debt monetization. Actions like those would be seen as confirmation that the debasement path is locked in.
Okay, let's pull this all together then. We've walked through the analysis of this CLSA report, the eroding trust, the debt loop, the prediction of debasement, the shift to neutral assets. What does this ultimately mean for you, the listener? What are the key actionable takeaways here?
I think the core message from this analysis is really an urgent prompt to fundamentally rethink what you consider a safe portfolio in today's environment. The old rules may not apply.
Okay, so step one.
Reevaluate your bond holdings.
Yeah.
Seriously. The analysis argues they're likely not the safe haven they once were and face real risks of losing purchasing power. That hard-no stance is pretty strong.
Type two.
Own scarce, non-sovereign assets. The analysis strongly advocates for gold, silver, and Bitcoin, framing them less as speculation and more as necessary insurance against potential systemic monetary debasement.
Okay, what else?
Third, generally favor productive equities over just holding cash long-term. Cash obviously loses value in a debasement scenario. Selected stocks, especially dividend payers, are seen as a relatively better place to be than cash or bonds.
And with inequities, that specific call to look towards Asia.
Yes, that's the fourth point. Keep an eye on Asia-Pacific equities for potential dividend growth opportunities, particularly where yields look attractive relative to local government bond yields. That suggests potential relative value.
The analysis uses this interesting term towards the end, zemblanity.
Yeah, zemblanity. It's described as the opposite of serendipity, not a happy accident, but the inevitable discovery of something you'd rather not know, an unpleasant truth making itself known.
So the takeaway is framed through that lens.
Kind of. It's about acknowledging the potentially uncomfortable realities the report analysis presents, the debt situation, the fiscal challenges, the likely consequences, and positioning your portfolio accordingly, rather than being blindsided by the zemblanity moment if or when it arrives.
Right. What would this deep dive into the analysis of CLSAs when reality bites certainly gives us a very clear, if unsettling, perspective. It builds a coherent case for significant financial instability driven by these debt and fiscal dynamics,
Leading to their conclusion that monetary debasement is essentially unavoidable.
which in turn, they argue, requires a fundamental shift in how you think about safe assets, moving away from traditional bonds towards scarcer things like metals and Bitcoin, and being selective with equities.
And you're digging into a specific piece of analysis like this, even if it's just one firm's view, is so valuable.
Yeah.
It forces you to grapple with a specific, well-supported argument and the data behind it, rather than just dealing in vague generalities.
Absolutely. It really sharpens the thinking. And it leaves us and you with a pretty provocative thought to chew on, building right off the core message of this analysis. If the very asset that defined risk-free for generations, the U.S. Treasury bond, is now, according to this analysis at least, potentially losing the deep trust of sophisticated market players, what does that fundamentally imply about our whole understanding of value and safety within the financial system going forward?
That's a big question.
Definitely something for you to consider as you look at your own approach.